Hey guys, welcome to Business Law once again. Today I want to talk about business organization. Probably the second thing you need to decide when opening up your own business, second only to what type of business you're going to open up, is what type of business organization you're going to utilize. There are four, you could stretch the list to five, you could probably even narrow it to almost three forms of business organization, obviously the subject of your latest assignment. The first is sole proprietorship, partnerships, um, corporations, and limited liability companies, or LLCs. And there's a whole host of subsections of LLCs, professional limited liability companies, things like that. So what I want to do is go through each of those forms of business organization. Probably won't spend much time at all on partnerships. A little bit of time, particularly with regard to implied partnerships, so you're aware of how you can kind of end up in a partnership without even necessarily intending to do so. But partnerships are kind of a dying breed when it comes to business organizations because of the advent of limited liability companies, LLCs. There are basically four main considerations to take into account when deciding what type of business organization you want to utilize. And those four factors are ease of creation. In other words, how easy is it to form this type of business organization? The liabilities of the owners of the business. Number three, tax considerations. And number four, the need for capital or money. And we'll look at each of these considerations as we go through each form of business organization. So the first, sole proprietorship, that's pretty easy. Okay, a sole proprietorship is one person conducting a business for the purpose of making a profit, essentially. It's very easy as far as ease of creation is concerned. You hang your shingle out, you put your sign up, you start cutting grass, you open a greasy spoon restaurant, whatever it is. Extremely easy to create. You might have to purchase a business license from a local municipal government, which is basically just a way to tax you. But other than that, I mean, you could start a sole proprietorship right out of the gate with very little to no paperwork. Like I said, you might need some type of business license from whatever local government you're dealing with. But essentially, you put out your sign, you open up for business. And it's just you. If you include somebody else in that, in the ownership structure, if they have a right to a share of the profits, liabilities, then you have a partnership. You don't have a sole proprietorship. So it's one person conducting that business for profit. So under the first consideration, ease of creation, very simple. One of the definite benefits of a sole proprietorship is how easy it is to get up off the ground. The second consideration, liability of the owner, that's a more troubling aspect. Troubling may be too strong of a term, but that's one of the drawbacks to a sole proprietorship. A sole proprietor is 100% liable for the debts and obligations of the sole proprietorship of the business. Now, what does that mean? If I open up a business as a sole proprietor and I owe money to a distributor or some type of other business or individual or corporation that I owe money to, or if I'm sued as a result of, let's say I'm sued in tort because I injured somebody that came into my business or something like that, I am 100% liable for all the debts and obligations of my sole proprietorship. Now, what's important to keep in mind when I say 100% liable, 100% responsible is it's not just whatever funds I have in the business. It's everything that I have. So if I'm sued or if I owe money to somebody as a result of my business, My personal assets, my home, my personal bank accounts, my property, like cars or anything else, is subject to being gone after, for lack of a better term, to satisfy any judgment against me that I may have received as a result of running that sole proprietorship. So all of my assets, everything that I have personally, is on the hook with a sole proprietorship. And again, that's one of the biggest downsides to a sole proprietorship is the unlimited liability of the owner of that business. Again, there's no separation between what's in the sole proprietorship and what's mine personally. It's all the same as far as if there's a judgment taken against me, again, because I'm sued or because I owe money on a breach of contract or anything. All my personal assets, my personal bank accounts, force a sale of my home under certain circumstances, force sale of my personal property, have my wages garnished. I cannot limit my liability as a sole proprietor. On to the next factor under sole proprietorships would be tax considerations. And the tax considerations are pretty good for a sole proprietor. You simply report the income from your business on your income tax return the same as you would from any other source of income. So just a regular job working for a big company, you report your income to the IRS, you pay taxes on that. This is the same is true with a sole proprietorship. So if I make $50,000 as a sole proprietor, then I report that $50,000 on my income tax return the same I would any other source of income, and taxed at a rate based upon how much money I made that year. So obviously the tax code is graduated. The more money you make, the higher percentage of tax you pay. In other words, somebody who makes $50,000 a year doesn't pay pays a lower rate of taxation than somebody who makes $400,000 a year. So normal tax considerations for a sole proprietorship. The fourth and final factor is the need for capital, raising money to start the business, keep the business going, expand the business. And here's where you're somewhat limited in a sole proprietorship. All the money that you need to get the business started and keep it going has to come from you, essentially. If you're going to borrow money from a bank to start the business, carry on the business, you are the only one that's going to be on that loan application. If somebody else helps to finance the business and takes an ownership stake in it, then you don't have a sole proprietorship anymore. You essentially have a partnership. So as far as needing capital, being a sole proprietorship can be somewhat limiting. Okay, so that's a basic rundown on sole proprietorships. Most sole proprietorships are small business. There's some statistics out there, I can't remember them off the top of my head, but most small sole proprietorships are under $1 million a year type businesses. Partnership is 2 or more people carrying on a business for profit. So if you and your buddy get together and start cutting grass, you're a partnership. Whether or not you sit down and hash out a formal partnership agreement, and a partnership agreement is essentially just a contract between the partners, laying out duties, obligations, what to do if the business is dissolved, those types of things. You don't have to have a formal partnership agreement to be a partnership. In fact, you don't have to have any type of agreement at all. The law will essentially presume you're a partnership if you're 2 or more people carrying on a business for profit, even absent any type of formal, written, or even informal agreement amongst yourselves. Partnerships are very easy to create. Again, you don't need any formal agreement. You just need to start conducting business. One of the not so great things about a partnership is, like a sole proprietorship, you cannot limit your liability. And so the debts and obligations of the partnership can fall on all of the partners. In other words, all of the partners can have their personal assets gone after once the assets of the partnership are exhausted. So, for example, if I have a partnership, there's three of us, own a restaurant. Somebody comes in the restaurant, slips, trips, and falls because the floor's wet, and they sue the partnership. They get $1 million judgment. Well, there's only $100,000 in assets within that restaurant, within that partnership. And once that $100,000 is exhausted, then the person who was injured, who sued us and got a judgment, can go after each of the partners' individual assets, forced sales of homes, go after bank accounts, forced sale of personal property. And when I say personal property, I mean anything other than real estate. So the liability of the owners of a partnership in a partnership is definitely a drawback, and you'll see when we get to corporations and LLCs a contrast there. Again, courts can find an implied partnership. So even though you don't have any type of an agreement, you've got two or more people carrying on a business, both of whom, let's say there's two, both of whom have the authority to enter into contracts and obligate the business. So your partner makes a bad decision, you could be personally liable for the economic fallout of that bad decision. It's best if you have a partnership to have a partnership agreement that spells everything out. But no matter what you do, you cannot limit the liability of the partners in a regular partnership. Tax considerations with regard to partnership are the same basically as a sole proprietorship. You take the money, your profits from the partnership and report them on your income tax return, the same as you would income from any other source. The need for capital is a little bit better than a sole proprietorship as far as trying to raise money, because if you've got two partners, you've got two sources of money to start the business, keep the business going, etc. If you go to the bank and get a loan, typically it's easier to borrow $100,000 for two people signing for the loan than one person signing for the loan, obviously depending on how many assets they have, their credit score, what kind of a risk they are, what kind of collateral they can post. But as a general rule, it's easier to get a loan with two people signing than one person signing. So there are some improvements or better considerations with regard to a partnership than there are with a sole proprietorship. I want to stress that partnership as a form of business organization is really kind of fallen out of favor in the business community over the last, 20, 30 years, at least since the advent of limited liability companies. And we'll see why that is when we get to limited liability companies. So I'm really not going to spend much time talking about partnerships. Suffice it to say, just remember that if you carry on a business with somebody else, you're going to be considered partners. And that could expose all of the assets, your personal assets, to being gone after. So the next form of business organization, and what we will spend the majority of our time talking about, are corporations. And we'll go through the list, the four factors with corporations, and then we'll expand on that a little bit more than I did with the other ones. So ease of creation, one of the drawbacks to a corporation. It's not as simple as starting a partnership or a sole proprietorship. Corporations are creatures of state law. And so in order to form a corporation, or what we call incorporate a business, we've got to make application to the state government. Typically that's done through the state Secretary of State. And you fill out a form. It's in West Virginia, it's really not a long form, a couple pages with basic information. What do you want the name of the corporation to be? What type of business it's going to carry on, names, addresses, things like that. Along with an application fee. In West Virginia, it's around $300, I think. But it's still somewhat of a process. You send all that information to the state Secretary of State, and you get incorporated. And the state issues a certificate of incorporation. And from that moment on, you can operate as a corporation. Now, let me take a minute here and explain an extremely important concept when it comes to corporations. The law treats a corporation as a separate legal entity. Okay? So, really, when you think of a corporation, you need to think of a completely separate and independent person. And corporations are treated like separate, independent people, essentially, by the law. So occasionally you'll hear a political candidate get into trouble for saying something like, well, corporations are people too. And in some ways that's pretty silly, but in other ways it's absolutely true. A corporation is a separate legal entity. It is not the owners, who are called shareholders or stockholders. It's a separate entity unto itself. And you'll see as we move along, it's important that not only the owners, but everyone else treat that corporation as if it were a separate legal person. The second factor, liability of owners, this is the whole reason for the creation of corporations to begin with. The owners of a corporation, again, the shareholders, our stockholders, have limited liability. In other words, the debts and obligations of the corporation are not the debts and obligations of the owners of the corporation. And that is true whether you have a single shareholder or you have 5,000 shareholders. So if I'm the sole shareholder, I'm the only owner of a corporation, I own 100% of the stock, of the shares, and the corporation is sued, or we owe a debt for supplies or something like that, my personal assets cannot be gone after. They are protected. Only the assets of the corporation are under threat from creditors or people who have judgments for a lawsuit, say in tort, against a corporation. This is why we have corporations, okay, is to provide the owners with limited liability. So let me give you an example of that. I am the sole shareholder of Ritchie Incorporated. I've incorporated with the state. I got my certificate of incorporation, and my business is a restaurant. A family comes into my restaurant. A part of the ceiling falls down and seriously injures 4 members of the family. They go to court. They sue the corporation. They don't sue me because I am not the restaurant. The corporation is, even though I'm the sole owner, the sole shareholder. They sue the corporation. They get a $20 million judgment against the corporation. Corporation only has assets of, let's say, $200,000. They collect that $200,000. They're still out the rest of the money. They cannot go after my personal assets to satisfy that judgment. I could have $5 billion, live in a huge mansion, drive Bentleys, okay, Lamborghinis. I'd be filthy rich. It doesn't matter. I have limited liability. They cannot go after my personal assets. This is the whole reason for corporations. If I've got $5 billion, why would I want to go out and start another business and risk being personally liable if something goes wrong with that business? I wouldn't. And so the whole reason that we have corporations is to encourage the flow of capital, opening businesses, employing people, all of those things. And it allows folks to limit their liability and encourages them to open businesses, essentially. Now, you could say it's not fair that these people were horribly injured in my restaurant and I have all this money personally and they can't go after it. And you may be able to make a good point there. But again, the reason for these corporations is essentially to limit liability. So when you hear the word corporation, I want you to think 2 things: separate legal person and limited liability. Those are the most important things when it comes to corporations. Let me go off on a little bit of a tangent here. Most of you all, when you think of corporations, probably think of large, publicly traded corporations like ExxonMobil, Apple, Walmart, Procter & Gamble. The list goes on. And Those are all large publicly traded corporations. And when I say publicly traded, I mean anybody can get online or call their broker or whomever and buy shares or stock in a publicly traded corporation. Anybody. Shares are available to the public. Okay? So if you want to buy shares of ExxonMobil, I wouldn't necessarily advise it right now. I'm not an investment advisor. But you could get on and buy shares of ExxonMobil or Walmart or Apple or any other publicly traded corporation and become one of the owners of that company. But the majority of corporations aren't big publicly traded corporations. Now, I don't have the numbers on that, so I'm a little bit hesitant to say majority, but I'm probably right. They're kind of small, or what we call close corporations, and we'll go through the attributes of close corporations as we progress. But you don't have to be publicly traded to be a corporation, okay? A single person can incorporate and be the only owner, the only shareholder of a corporation. Most businesses that you deal with on a day-to-day basis, even small businesses, a lot of them, perhaps I shouldn't say most, but a lot of them are corporations. So just in Elkins, you go down to Lynn's to get beer, cigarettes, or lottery tickets. They're incorporated, or at the very least are an LLC. And we'll see when we get to LLCs that LLCs are separate entities and have limited liability as well, with some important tax differences and organizational differences. So don't get bogged down in thinking, oh, corporations got to be ExxonMobil, Procter & Gamble, Mylan Pharmaceuticals, things like that. No. Plenty of small mom and pop corporations, for lack of a better term. Again, we'll get to close corporations. So there could be a single shareholder. There could be 2, 4, 10 shareholders. You get to big publicly traded corporations, thousands and thousands of shareholders. Okay? So be careful about how you think of corporations and get away from just thinking of publicly traded corporations. These smaller mom and pop corporations are not publicly traded. The general public cannot buy shares of stock, cannot become owners of those corporations. Their shares are not publicly available. There is no market for those shares. And almost all new businesses these days are attempting through the formation of a corporation or an LLC to limit their liability. Okay. Now back to corporations under our 4 factors in deciding what form of business organization to open. The third, we've gone through ease of creation and liability of owners, so tax considerations. Now, here is a drawback to corporations and tax considerations. So, the drawback, or one of the drawbacks with corporations is corporations, again, are separate legal entities. So that means that the corporation has to file its own tax return just like an individual person. Okay? So corporations have rights just like normal people do. Corporations have constitutional rights. Corporations can own property in their name, can sell property. A corporation can bring a lawsuit. A corporation can be sued just like an individual person. And a corporation has an obligation to file its own, separate and apart from its owners, from its shareholders, its own tax return. Corporate rates of taxation are typically higher than rates of taxations on individuals. Now, I'm not an accountant, and so I'm not going to try and give you rates, and there's been some significant reductions here in the last several years in the corporate rate. But you have to file a separate tax return, typically at a higher rate of taxation than an individual. There is also the problem with corporations of double taxation. In other words, the same pool of money being taxed twice by the government. Now, how does that happen? When corporations return money to their shareholders, it's called a dividend. So certain corporations, their stock pays a dividend, others don't. Some pay higher dividends than others. But all a dividend is returning money, profits, to the owners of the corporation. So how does the double taxation work? Let's say a corporation has net profits of $1 million for a year. That $1 million is going to be reported on that corporation's tax return, and a certain percentage of that profit will have to be paid in taxes. So let's just say the corporation pays 20% of their net profits minus deductions and everything else to Uncle Sam in the form of taxes. Then they use that same money to, what's left, to issue a dividend. Each one of the shareholders is then going to have to pay a tax on that dividend income that they received from the corporation. So what happens is you have double taxation. That same pool of money is taxed twice. Once under the corporation's normal tax return, and twice, or for the second time, when the individual shareholder pays a tax on that dividend. And the tax on dividends is not small. So one of the big problems with corporations is double taxation. And we'll see when we get to LLCs and other forms of limited liability organizations that one of the reasons for their advent was to get rid of this double taxation problem. And we'll see how that works. So tax considerations not great with a regular type of corporation. There are different types of corporations under the tax code that get rid of some of these problems that we'll get to later on in the business organization lectures. One of the benefits of corporations, the need for capital, the fourth factor that we've discussed, or that we are discussing. A corporation can raise capital by selling shares. Okay? So even if it's a single shareholder and I need to raise some capital, I might decide to sell a certain amount of stock to somebody else and allow them to become a shareholder or one of the owners of that particular corporation. So a great way for corporations to raise funds is to sell shares. So definitely an advantage there. Again, we are going to spend the majority of our time talking about corporations. And I cannot stress enough that you guys need to think of corporations as a separate legal entity. So even if I'm the sole shareholder of a corporation, I have to have an arm's length relationship with that corporation. I've got to have separate bank accounts, okay? I mean, that's an easy example. I've got to have separate bank accounts. I can't treat the assets of the corporation, even though I'm the only owner, the only shareholder, as my own. I've got to treat them as if they belong to somebody else, okay? The corporation should not be paying my personal power bill, okay, or any of my other personal bills. And when we'll see as we move along that if you don't treat a corporation as a separate legal entity, you risk losing your limited liability. You risk losing the main advantage and the main reason that you created a corporation in the first place. So, separate legal entity, limited liability. Pound it into your heads, okay? This is why limited liability is exactly why corporations exist. All right, I want to stop there. I want to try and keep the lectures to about a half an hour. If you haven't gotten your assignment done yet, make sure you get it to me by the end of the day, Friday. Hopefully, guys, you all tune in. Please leave a comment to let me know that you've watched the video. Go through the last lecture that went through the test questions. Again, everybody did great on the test. I'm happy. What I'm doing as far as grading the assignments are, as long as it looks like you've made a good effort to do it, I'm giving you full credit for that. Each of the assignments will be worth 5 points. We'll add that onto your grade. So it'll almost count like an extra credit. But everybody seems to be doing very well, so I'm pleased. We're getting close to the end of the semester. We'll have a final exam. It'll just cover. It will not be comprehensive. I repeat, the final exam will not be comprehensive. In other words, the final exam will only be on what we've covered since the contracts test. So this lecture and everything going forward. We may have another assignment or two at some point. And I will offer some extra credit that I'll get to you here in the next week or two. So, all right, guys, stay safe. Hope everybody's doing well. As always, call me with any questions, comments, concerns, anything you need. I'm available to you by text, phone, email. All right, thanks, guys.